All right, sounds good.
All right, KiiChain, everyone. Welcome to another Union Hall Builders Cast. Today I'm here with Ben from Talus, who knows all about AI. And I don't think we've had you before, but I think we've done a Spaces before together, Ben. But I'm not 100% sure.
Yes,
Yeah,
a
right?
few months ago, quite a while.
Exactly. Yeah, yeah. And Danielle from KiiChain. So basically, we're going to be talking about payments and AI, is what I think this episode will be about. So if that's of your interest, please stay around and listen in. Ben, maybe kick us off and give us a quick overview of what you guys have been up to.
Yeah, thanks. It's great to be on the Union Cast. Union's a good partner of ours, and yeah, my name is Ben. I'm the co-founder of Talus. We're building a AI infrastructure network for consumer use cases, which of course includes payments. And we've built a new framework for agents called Nexus that is one of a kind in the industry because it lets you express agentic workflows on chain. So you can have an agent that's like an AI smart contract, an agent that has all the properties of a smart contract: transparency, composability with other on-chain programs, verifiability, censorship resistance. And we think this is going to be very, very valuable as more and more people rely on agents for more and more use cases. Businesses rely on them for enterprise use cases. Normal people rely on agents every day for every single task in their day-to-day lives. And we operate Talus Network is a decentralized network of leader nodes that can port inference from off-chain resources to these on-chain workflows. So you get kind of like a decentralized Zapier. So you can have an LLM that's generating inference off-chain. We have a network of nodes that can take that inference and communicate it to the on-chain workflow. So what we're trying to create here is a truly decentralized network of AI agents.
Gotcha, makes sense. So should I then kind of like mentally put you in this category of on chain you have all these agent configurations? As a user, it's maybe to me a little bit like a marketplace or somewhere in that direction that I can almost see like, oh, there's like thousands of agents available to me, so much hook into each other, and I get to like pick and choose and kind of operate in that ecosystem.
Exactly. Yeah. So the workflows are all expressed on chain. You can use whatever workflows you want. And then for off chain tools, you can also use whatever off chain tools you want. So whatever model, whatever data you want to feed into the model, whatever additional security guarantees you want to give to your agent. Like, for instance, Sui has a really cool framework called Nautilus, which is a system of using TEs to verify inference. It uses AWS Nitro. So there's all kinds of additional tools that you can add into your agent for whatever you want your agent to do. On the developer side, we just wanted to give developers as much functionality, as much freedom as possible to build what they want to build.
Very cool. Very cool. And then on to KiiChain. Because you guys are kind of like on the not opposite side, but more focused on the kind of original financial side of crypto, right? Like payments and such, and bring those to the masses.
Absolutely, absolutely. Well, hello everyone. My name is Daniel Arenas. I'm the CEO of Key Global. We have a layer one FX chain for on-chain 24/7 on-chain FX. We also have an application and a service, which is we created the world's first 24/7 FX desk. Just to kind of give a little color on that, FX desks at the banks operate from 8 a.m. to 1 p.m. globally. That's how they have it paired up. What we were able to do was we created a partnership with Cohen and Company out of New York through their fund Veller to be able to do a partnership with them in order to create a 24/7 FX desk where you can settle FX 24/7, holidays, weekends, and every single day of the year. What that did is it really blew open the operational hours of those FX trades and those kind of cross-border payments by 8x within the same, by 8 times the operational hours that you have now. So, usually you have around 20 to 25 real-world hours a week with the banks. With us, we have over 160 a week. So we basically gave everybody another, 20 hours a day to be able to trade. And what we've done is we've been able to partner with dollar-based stablecoins and non-dollar-based stablecoins in order to pair that with our application and be able to provide that service. So we launched our pilot in Colombia and South America. We've been targeting, we started with Colombia because within LATAM, the use case and the demand is extremely high. But additional to that, Colombia has the most stringent banking regulations and so forth. So we figured it was a good place to start the pilot. And then from there, everything would be pretty smooth. So we were able to partner with that. Cohen came in with, we have a $10 million credit trading credit line with them. And we've done the pilot in Colombia. It's gone extremely well, fortunately. And we've seen a ton of demand there. And really what we're solving for and what we realize is that the real use case that we see with blockchain is that we realize that, there's decentralization and money should move the way we want it to move, which is 24/7, no limitations, no extra fees, and no need for banks and governments to be in between every single move we make, right? So I feel like what blockchain and crypto did is it really brought us back to almost like a cash system, except digital, right? Which is when obviously commerce was moving as quickly as possible, less interruptions and things like that. So that's what we've really focused on. That's been our number one target. And, strategically what we're doing is we're partnering with non-dollar-based stablecoin issuers. Right now we have over 10 of those on chain, and with PayFi companies and really being that layer that can provide that global operating system for on-chain FX, right? And then we're also, and then we're working with, institutional players that are really pushing that use case and they want to transfer to that. So whether it's, market makers that are in the crypto space or FX traders that are in TradFi. One thing that we found that was interesting is when we brought them the model, they jumped at it immediately and they said, hey, we'll switch to on-chain, right away. So what we see in the future with what we're building is, the opportunity to really make KiiChain the global layer one for FX, for global FX, right? And then with our application with KiiX, we're going to be able to provide users, whether on the institutional side, 24/7 FX, give them the best service, and obviously same day settlements and global transactions. But for retail users, what we're going to allow them to have is they're going to have the benefits of local banking services in different countries, right? So when you want to move money in other countries, you're going to be able to make a local transfer rather than what you have to do now, which is SWIFT and things like that, which is where it gets complicated. So what it allows us to do is it really brings out the big opportunity to really decentralize the whole system and go completely global. So if you're going to have 24/7 FX desk at the touch of your hands, which for cross-border payments and movement in general, where crypto's going, I think it's the most pivotal area that's really going to
very cool. So if I have to position you guys in my mental diagram of crypto projects, I guess I have to put you plasma category, but not focused on US dollars, but focused on assets in South America, right? And then potentially providing neobank kind of opportunities on top of that. Is that correctly positioning you in the kind of stable coin infrastructure space?
Yes. What we are is we're basically the best friend of dollar-based and non-dollar-based stablecoin providers, except non-dollar-based stablecoin providers are just now emerging, so they're young and they're coming into the system. And what we are is their best friend because we come and directly provide liquidity for them. So we're one of the first ones.
How do you guys? A couple months ago, I was traveling around in South America and went by Brazil, and there they have PIX, right? They're like a payment sort of blockchain. How do you guys compare to PIX? It's slightly different what you guys are doing, right? It's more trading infrastructure than just direct payments in stores, or is direct payments something that you guys are also focused on?
No, right now it's mainly cross-border payments what we're solving for, right? So it's mainly people that need to transfer whatever the stable is to the local fiat, right? and that's where we come in, and we can solve for that. And what we do is like I was mentioning, we partner with non-dollar based stablecoin providers, and what that allows you to do is take your USDT, USDC, and do an immediate settlement to, for example, the Colombian stablecoin or the Mexican stablecoin, Brazilian. The PIX that you're referring to is in Brazil. So Brazil's quite advanced with that. We actually partner with one of the largest banks and the largest stablecoin provider in Brazil, which is Brasa Bank. So, no, I mean, the thing is, the difference with us is that the rest have limitations, right? So a lot of these services, they're very retail focused. So they have like trading, they have like transfer limits and things like that. So they're good. They're solid when you're sending, $50, $100 and things like that. When you're more institutional, or you're an aggregator, or companies like that are more solid, they need a much more customized service, because you're talking about larger amounts, right? Uh, big size transactions and things like that, which the smaller systems they have with the bank, they just won't do that, And also, a lot of them have depending on the country, a lot of those services slow down during the weekends and holidays, and there have been systems failure. That so, no, what our number one thing is to be able to create the fastest service and give you the most access to the most amount of non-dollar based stablecoins, so we can really get that market to flourish. Because I've seen non-dollar based stablecoins is really one of the biggest markets that's really emerging now, that like every country realized, like, hey, we should just have a stable, so fortunately the private sector is really jumping on that. And our goal is really to connect that and take, traditional FX on chain, right? So that we can really get that benefit of 24/7 transactions, which is ultimately what stimulates the economy.
Yeah, it makes sense. So yeah, not myself, not that familiar with remittance as a space itself, but something that does pop up on my timeline. I'm constantly associated with stablecoin payments, and kind of like where we all think this is headed is agentic payments, right? I saw A16Z just doing a report that they think agentic payments and agentic like cross-border payments might outgrow regular payments altogether. And that's going to be mainly the volume. How do you guys see that? Is that something, Ben, that you anticipate with Talus, and it's like infrastructure like Key something you choose?
One of the reasons why we started Talus is because when I met my co-founder, Mike, he was being incubated by Polychain, and we discussed all of the cool stuff for AI and crypto to come together, right? And so training was one. I would say compute is one, particularly inference. Like, it would be really cool if you could incentivize inference, because inference has a lot of sequential dependencies, doesn't need to run on really powerful hardware. It can run on, like home hardware that maybe if you have an old laptop or something, it can be making money for you, contributing to inference. So there are a few projects that are doing that. Data is the other one, like verifying data, or like data scraping. There's a bunch of projects that were already doing that. And then the final thing that we thought was cool that, we decided to build with is AI buying stuff for you. That's really the idea of these agentic workflows as it relates to blockchains and as it relates to Web3, is you have this autonomous workflow that can transfer value for you. And so, yeah, that was certainly what we envisioned. Agents automating everything in DeFi, and that's the future that we're working toward. Is like, it's very annoying that you have to rebalance LP. Even today in 2025, you have to rebalance LP in the overwhelming majority of pools, if you're a liquidity provider, because the AMM doesn't want to warehouse that risk for you in resetting the range, right? That's a great example of something that AI could do for everyday people, everyday users of Web3. It's very annoying that it's so difficult to find yield across different chains. Like if a yield, I was just looking at yields on Katana the other day. Yields on Katana are going crazy right now, and hardly anyone knows about them, and hardly anyone knows how to route their liquidity over there. If you have liquidity on Solana or something, hey, you have no idea. So all of that, those are all agents that Talus is working on. I'd really like to work on trading as well. Trading is really difficult, mostly for AI reasons. It's really hard to get. So an LLM is not good at time series. and ideally you would like a different model on the back end doing the trading for you. So that's definitely something that we're working toward. We're partnered with Zoe right now, which is an AI perp dex on Sui, and they're using our framework to build some agents. So we're working on that all the time.
Yeah, interesting. Because my thought is thinking like, obviously if like on chain, or did we lose him? But I think at least we have like on-chain agents, but I actually think like regular agents and regular payments agents is like probably the much bigger opportunity here as well, right? Where I could imagine like as a developer, me having a software as a service, but no longer actually having a front end for my service at all, and just like AIs use Google. They see I offer an API that you can get certain data from me or whatever, and you can use like Coinbase's new like standard to do the payment for it, right? But I wonder, in this world where all these AI agents are doing like micro payments to fetch data, are they going to do all of that in like USDC, USDT, in stables? Is this going to be like a mix? Right now, it seems like Coinbase is pushing a lot to obviously use like USDC for this, right? Because Coinbase is owns 50% of Circle, so that's
an interop question.
Exactly.
Because that's effectively the end state of interop. I think is where you have like ZK solutions, like something that Union does. That's maybe you guys could do consumer or enterprise, but I think that's where interop is trending for most institutions. Is that you just have a settlement asset like USDC. That's how that's how CCTP works. For instance.
Yeah. So will the backbone basically be like a US dollar derivative as like a settlement asset for this like 30 trillion market? Or are we going to maybe see that it has to be like in certain local assets? I find that like quite a curious idea. Like, will there maybe be like, is it like going to kill FX altogether? Or is it indeed going to 10x FX potentially? Because like way more conversions have to be done.
That's what I was going to say. I think it's the opposite. It's that it's gonna 10x. It's going to 10x conversions, because ultimately what I don't see anything really going global, because we've already seen it with USDT. You know what I mean? USDT is taking over the market. It's established itself as the dollar, but the need for the local stables, it's clear, because even though USDT was the first, highly successful use case, the use case for crypto across the board for countries, especially for local stables, is it's tremendous, because it brings you back to almost like a cash system, and you can either keep it digitally in your wallet, but you have the local currency for all intended purposes, because it's a local stable, and then from there you can just redeem it for the actual local currency. And I don't think any sort of government or the market in general is going to want to lose the arbitrage opportunity, or like the local benefit of having the local currencies themselves, because the adoption to try to make a switch to just have like a global cryptocurrency, I just don't see it. I think USDT as far as it could go, and then what naturally organically happened was not more USDT market share, but more local stablecoin providers growing and starting to take market share in that direction, right? So I think what it's actually going to do is, I think it's going to create more conversions. I think it's going to create a much more robust market, because there's more arbitrage opportunities, and there's also more growth opportunities across the board, right? Like, I don't think the market really wants. I mean, like I said, like I think the market doesn't want like a mass monopolistic player. And I think we saw the opportunity to do that was with USDT, and then what the market naturally just started shifting towards, if there's so much, because I think that if you're going so much in one direction, then the other side that's empty becomes a huge business opportunity, right? So I think because the market's like a living organism in a sense, and it's very proactive, I think it's what you mentioned, what you just mentioned, which is the trading and the swaps are going to increase, and I think it's just going to take the FX market completely on chain over time, and we're really going to get the benefit of decentralization and immediate settlement while still having the connection to local fiat in different countries.
Yeah, it's interesting. I know at least within Europe, kind of the dominance of US stablecoins is seen as a problem, right? And Lots of like individual European countries are like trying to figure out how do we like get the euro stable coins to be more competitive. Biggest issue so far that they kind of identify is yield associated with it, right? Like US stablecoin is so dominant because there's good yield to be had on it. But on the other hand, to be honest, if you didn't make, what is it, 22% on your US dollar stables over the last year, then technically you're down compared to the euro combined with inflation. So maybe yield isn't that important. I wonder if it's like kind of the same. I'm sure it's the same like in China. They see US dollar stablecoin dominance also as problematic. Is it seen the same in South America, where like potentially countries see it as something of like national interest to make sure that their own stables become more widely used? Or is the US dollar like also fairly accepted over there? There's no, for example, in Paraguay, right? They just use US dollars for whatever.
Yeah, there's certain Latin countries that are dollar based. Panama is dollar based as well. But no, in general, the countries throughout emerging markets and in LATAM, they're not really looking to switch over. I mean, some countries that have just had horrible fiscal policies and ran through a lot of issues, they've just basically given up and switched over to the US dollar because it just simplifies things. But in general, the big opportunity is people do want to maintain the local government currency, and they do want to see the benefit of their local stables, right? Because that's how you can, adapting the market to switch over to dollar is way more complicated than, and it's just too many moving parts compared to switching the market to the same currency but just in crypto, right? And I think that kind of adoption will take place just because crypto is so convenient, right? It's the same thing as cash except in digital form, and I think what I'm really seeing moving forward with the market is a significant growth in non-dollar based stables, especially because it's just such a great business opportunity for young entrepreneurs in the space to take on basically a relatively simple task, right? I mean, creating a non-dollar based stable is not like super complicated. The business model itself is pretty straightforward. It's you get basically a banking return on TVL. So because the business model is simple, because the need is so massive, I think it's a great entry point for entrepreneurs, and I think the natural organic movement towards that sector is going to come by the local players in each country just establishing the local currency. And for cross-border payments into that country, there's nothing better than being able to do it with a local stable, right? So those kind of inherent benefits, I think, just make the market too attractive for entrepreneurs not to start jumping at it. And like I said, as that happens, I think USDT and USDC will still be, they'll still reign king, and they'll be the two strong dollar-based providers. But we'll have more in the FX space. We'll start seeing more, let's say, Colombian peso to euro. Right now, mainly it's USDT to everything, right? USDT to peso, USDT to Brazil, USDT to Mexico, Argentina. So what we'll see is we'll start seeing more actual swaps between stables, not just USDT. That's how I'm seeing it.
Makes sense.
Daniel, if I could jump in here, that's something that I've been wondering in a macro perspective, because here I live in the U.S. and with the current regime, there's a fundamental shift in how the U.S.'s economic position for how we're going to handle trade. We're having a huge realignment in the balance of payments. A lot of people interpret that as in the future, meaning a weaker dollar in our bullish EMs. So, you're saying you're seeing a huge influx in non-dollar stables. Do you think, is that the macro view that you take?
Yeah, absolutely. I see that arising. For example, we brought on chain 10 globally, and we're on the hunt for every single one that comes out. We want to bring them on chain. And a lot of these companies, like I mentioned earlier, we're a great partner for them because they're just starting off, and we're coming to them saying, "Hey, we have proprietary liquidity. Come and deploy to our layer one." And I mean, most things I was having with these companies, with these non-dollar based stablecoin issuers, we had this whole pitch of why you should deploy to our network and everything. As soon as we told them what we were doing, and they went to speak, the first thing they said is, "How do we deploy to your network?" Right? Because what happens is when you're starting out as a stablecoin provider, you need the liquidity, right? You're looking for liquidity partners. So when we come in and we can provide that, it's a great push for those providers. But really, what I'm just seeing is it's just really realistically from the market opportunity. There's a clear, it's in a lot of ways it's low hanging fruit, right? Because what's the quickest tech development that you could do? A non-dollar based stable, right? That's pretty straightforward, simple. You can run it on basically anything, right? It's really the back end infrastructure of getting the regulatory set up, getting the partnered bank that'll let you hold, and then negotiating the fees that the bank will pay you for your TVL, right? So what happens is that if you look at that, that's a very attractive. Now the need for that is very high, right? So that's a very attractive way to get into the crypto space with a product that has a huge demand, a very stable return, simple business model, and that the market itself is always going to take on, right? Because any market that is taking on any fiat will 100% take on the crypto equivalent of that fiat, because it's just more, it's better. Rather than have $10,000 in cash, you're going to have $10,000 in your wallet, right? That you can redeem whenever you want to local fiat. So what I'm seeing, especially going to stablecoin events and conferences and things like that, is that there's a huge push for that. It's a huge push for that because I think along the whole vertical, if you're an investor, VC or fund or anything, the stablecoin model is a pretty simple investment. It's not super high risk, right? It's not super costly in terms of development and burn rates and things like that. So I think it's very attractive. Like I said, from an entrepreneurial standpoint, I think it's a low hanging fruit that you can really enter the sector and enter strong. So I think there's a huge push in that sense. So I think and then for the consumers, there's no consumers that don't want the local fiat in crypto form, right? Just because of all the benefits, and obviously you're just immediately operating in a parallel system to whatever the banking system is in that country. And with the way TradFi banking has become in terms of fees and delays, especially in emerging markets, you have a huge demand. So on the money side, it's not difficult money to raise. On the entrepreneurial side, it's a very achievable task. On the market side, it's a very demanded product. And that's what I've been seeing. So that kind of trifecta is just creating like a very fertile ground for all these stables to start popping up. But Ben, do I think like all of them are going to make it, kind of thing? No, of course not. But do I think that there's a gold rush in that regard? 100%, 100%. Because if USDT has shown us anything, is how beneficial a stable can actually be. Because just look at the market today. How does it work today? If you're a degen, you got USDT, USDC. You go anywhere in the world, and then you just convert to local fiat, and you're in play, right? The only shift here, it's like 1 degree to the right, which is now I'm going to be able to go anywhere, let's say with the Colombian stable, and it'll have a market, or the Argentinian or the Mexican. The Mexican peso is actually extremely liquid. Brazilian BRZ is extremely liquid. So we're already seeing emerging markets where this thing's completely taken off, right?
Yeah,
So
I've seen some new startups recently that basically offer yield from these tables converted, right? So you hold like US dollar, you get exposure to yield. Because I think actually, like in Brazil, the interest rate on your savings account is very high, right? I think it's like double-digit interest savings that you get. So
oh,
there's like quite nice safe yields as long as you're like have exposure to their currency.
100%. It's funny that you mentioned that because we just partnered with Noon. They're the yield dollar-based stablecoin from DCLM. DCLM is a market maker, and they came out with Noon Coin, which is a dollar-based yield product, yield coin, and it's been extremely successful, very solid. And that's another thing. That's a great point that you made, Carol. That's another big shift that I think, Ben, is happening, is like not only the stables, but the stables with yield, right? Because that's becoming extremely attractive for people that want to, for example, save in dollars. So, for example, in Noon's case, if you want to save in dollars and get a yield on that return, and you're in, in LATAM or Africa or Asia or wherever you want to be, wherever you are, it's an unbelievable way to really safeguard your savings and earnings, because you can hold in dollars, so you have the reserve currency savings structure there. But then again, then you're getting yield, and you're getting that yield in dollars, right? So that's a big return. That's an extremely attractive product, and we're really happy that we were able to partner with Noon on that, because they're doing some really interesting stuff. And from there, a lot of other things are spawning. They're starting not only create yield, like you mentioned, Carol, for dollar-based stables, but for non-dollar based. So as soon as that starts happening, and they're more attractive yields than what the banks give you, all of a sudden you start pushing more of a savings culture. Because I think a lot of the savings culture that evaporated was because you just weren't getting a significant yield from the banks, right? So it just kind of
The bank walk, as they called it. The bank
what?
walk. The bank walk. The bank run. The bank walk.
Yeah, exactly. It's the bank walk. So like it's just like you're not getting anything. So what happens is that kind of pushes you away from savings, because if you're putting, for example, a lot of these yields, they're yielding 9, 11%. If you're getting 9 or 11%, and you all of a sudden that's the kind of return that, obviously you're not looking, that's not an outsized return or anything, but that's the kind of return that regular users could obviously absolutely focus on savings with, because a 10% return on savings, that's something that will really jump out at you. 11%, 12%. So those are the kind of numbers I'm seeing. And then when you have the banks, they're not giving you anything. You know what I mean? It's all of a sudden these stables with yield become basically a beautiful cash account with yield, right? Because you can, most of these, I mean, with Noon, you can liquidate within 24 to 72 hours, depending on what type of yield what category of yield you enter, right? So I mean, think about that. You're getting, let's say 9 to 11%, and you can exit, immediately. So that, I think that's going to create a shift back towards savings and capital accumulation, which I think is kind of left us, and we're much more in the era of like leverage and like high growth plays, right? Because if you take away the conservative solid return, and there's just like basically no return on being conservative, then you basically push the market to have to be aggressive. Whereas if you're getting that 9-11%, then you have a magnet for people that are like, hey, I'm good with just like collect, getting my savings together, putting in there, and then really building out. And if you look at it, 9 to 11%, that's basically an index fund, right?
Yeah.
So
we like, I remember observing that really clearly for the first time 2 years ago, when we had the SVB like mini crisis in the U.S. and started, the mid-sized banks started to see the consequences of this bank walk. And one of the things you learn, like I saw in that, is why can't banks raise yield? Well, their margins are really thin already. Like these are really tough businesses to make work, and that's why we're starting to see consolidation toward the bigger banks. So this is the perfect industry. I agree for disruption with blockchain technology. So what, like from a technical perspective, what are the tech advantages that blockchains provide that people really want to see for FX in particular? So like you guys are in L1, for instance, like how important is finality? Like having a decentralized validator set and ensuring that you have finality on the execution layer, on the same layer that happens with that execution is happening. How important is that to people in onboarding FX trading on chain?
I think it's an option. I think it's beneficial. Like I said, I think I think it's important for the stablecoin providers, right? Because since in our case we're a layer one, we're bringing them liquidity. They want to create that partnership. Obviously, there's other chains that you can do it. There's the cost and the settlement times vary on that. In our case, the reason we chose to create a layer one is because we wanted it to be hyper specific to us, which is extremely low gas fees, extremely fast transactions, right? At the same time, we're able to operate with other chains, right? We're a Cosmos SDK, we have interoperability, right? So I think in our case, it's really important for us in the sense of having the option available and being the pioneers of bringing those non-dollar based stables onto one chain and have a chain that's specifically focused for that, that's going to give you that specific service, right? Because if you do it with, if you do it with like an ERC, the gas fees are high, settlement times are high, so that's kind of like, it doesn't really work. 12-minute settlement, that's not really what you're looking for, right?
That's what I was going to say is like, that's one of the arguments, not that I have a position on this, but like the arguments against an L2 for like really high frequency trading is that if you have a longer time to finality, then
you kill the
have
business.
to go wider on spreads because price can move away from you, before the trade is finalized.
Exactly, and you nailed it. That's exactly why it is important to be on chain. Obviously, what happens, a lot of it is determined by what, and you give different options, right? When you're with our chain, you're obviously with a customized layer one that's giving you the lowest fees and the speed, because we're focused on providing that institutional grade service, right? Now, the user is going to be able to benefit from that, but also select what he wants, because when you have somebody using on-chain FX that isn't time or price sensitive, right? They might just do ERC out of convenience, or Polygon or something like that, out of just, no big deal, it is what it is. Whereas if you're a cross-border aggregator, or you're an institutional large volume market maker and things like that, you're 100%, you're going to want finality on our chain. You want to handle everything through there because you need the speed, you're time sensitive and you're price sensitive. So it's a completely different game, right? Because there's FX as a business, and then there's FX as a service. So the FX as a business is the people that are running arbitrage and things like that. FX as a service is the people that need to make cross-border payments, which is an FX trade at the end of the day. But if you're making cross-border payments, there's levels to, price sensitivity and time sensitivity, right? So like remittances, they're a little bit more flexible in terms of time and payments. Arbitrage players are much more sensitive to price and time. So importers, exporters, they're less sensitive to price and time because they have ongoing businesses and things like that. So, if you do a settlement in 6 hours or 8 hours, like, they're okay with it. It's not a big deal for them. Even the next day, it's, and because what they're liquidating is that what they've made in their real business, there's also there's less price sensitivity, right? So in general, it's extremely important on chain, depending on who you are. And that's what we've really been able to like afford to the market, right? Give the user the ability to use the chain that he wants, but still provide, a top tier, exceptional institutional grade chain for those that want to use it. And so that we can attend to the market that most moves this, which is the institutional market, right?
I get why, like I'm a blockchain maximalist, right? Like I think a lot of them love seeing blockchains, love seeing them produce blocks, working on them. What I just always wonder is like the biggest pro I feel in this situation is like you have access 24/7, right? And you previously didn't have that. Why did legacy companies not provide 24/7 access, right? If you see your market is going to get like taken over by guys like you, right? They're going to outcompete you. Why do they stick to this like 9 to 5 schedule? I mean, they're running centralized servers. They could just keep their services open for longer, right? Why didn't that transition happen, do you think? Like, why is it so behind?
Well,
the analysts have to sleep too, right? I guess
What?
that's it. The analysts have to go to sleep too, I guess.
Yeah. Well, it's well, you know what it is? It's just the limitations of the traditional system, the way it was set up, right? So the reason they do it like that is so that they can coordinate timeframes globally at the same time, right? And the systems that were created based off of that. So with that also comes banking regulations and certain infrastructure limitations, and then regulations that have come over time for the banking sector, which, as we know, is like highly regulated and overly pressed in every area. Like Ben mentioned, that's why the margins now are so low, because they're very like limited to what they can do in certain ways. And unfortunately, the banking system has become almost inverse. It used to be that the system was focused on the 95% of people that were legitimate, and they treated everybody as that, and then they watched out for the 5% that was illegitimate. And then now, if you look at the banking system, it's really, almost based. It's a structure that assumes that 95% of people are illegitimate, right? So like you have you have transfer limitations. If you make one transfer at the wrong time, you get your account blocked, and you get a call from the bank, and you get a message, and then you got to answer back on an email, and then unblock. And God forbid you leave the country without informing the bank, and then you go use your credit card in another country, and then that gets, there's all these things. And I think all of that is part of the bureaucracy and let's say fat that's accumulated in the system that's led to the creation of blockchain, that's led to these things. And
Do you even think that
changing.
regulation is going to come after you? Like, you kind of like, I get from technical perspective, you guys are superior. Are you guys like about to be smacked with the big regulatory hammer and you have to do the same as these banks? Or are there ways for like blockchain tech to kind of like provide the same like legal guarantees?
Yeah, well, the thing is, ultimately, you still have a connection to the banks, right? But you're able to, with pre-funding accounts, you're able to maneuver within them, and then using stables, you're able to move. I don't see the banks trying to compete with us and becoming a 24/7 operation, mainly because since it's a global wide system, you would need global compliance. You would need regulatory reform. You would need approvals, political approvals in every country. You would need just international banking laws. I mean, the amount of that's what you just said is actually the problem that we avoid. What you said about the big regulatory issues, the banks have already got nailed with all that, and that's why they can't move. I mean, what you just said, even if like Bank of America said, you know what, we need to go do a 24/7 FX, and they were completely on board to do it, it would possibly take them 10 years to be able to, like, for that to be global. Whereas with crypto's already built into that. And then the reason we're in blockchain and crypto, we're able to avoid those regulatory issues is because if you touch crypto, what you do is you just take yourself out of the market, right? So like if you're any country and you create like significant regulations on crypto, the market's digital. It'll just move away. Like, not crypto friendly country, move. So what happens? No entrepreneurs create crypto in that region because the regulation doesn't allow it. No capital is going that way. No real arbitrage interest or things like that are moving. So the sector just dies out and they focus everywhere else. And the best example of that is El Salvador. El Salvador was an absolute disaster and center of the most homicides in the world. And then they took a completely pro-crypto approach to revolutionize their economy. Now they're one of the most successful, most international investment destinations that exist. Tether built like a 20-story building, or bought one for their offices there, right? Crypto companies are popping up right and left. They created extremely crypto-friendly regulation, the first one in the region, and they've become an absolute like magnet for everybody going there, right? So I think the secret is out, which is the way you regulate crypto is kid gloves, like a little bit of here, a little bit of there, but leave the market alone. For example, not only in El Salvador, where we're getting both our licenses for the exchange and for the blockchain, we immediately get access to banking. Like the banks absolutely bring you on, they endorse you, they support you, they're pro they're pro crypto, and then on top of that, the tax rate is zero. You're getting all these tax credits for doing that. Why? Because what El Salvador realized is, like, in order for a company to prosper from a specific market, it doesn't need to be taxed. It needs to be active, right? So El Salvador is seeing a ton of construction, a ton of tokenization happening, a ton of crypto companies setting up shop there. So you're getting all of this kind of, economic stimulation, even though the government's not taking any money from it. And the reason you're getting it is because since the government's not taking any money, people are putting that capital right back into growth in their businesses, into their employees and so forth. So I think enough people, enough countries have already tried to do like the strict crypto thing, like, hey, we're going to regulate, and then they realize that it's not like a physical bank. You can regulate a physical bank and limit it to what it can do. The moment you make crypto not profitable in your country, people just don't. Crypto just doesn't go there. Period. Like we just move somewhere else, right? Like
Yeah,
what El Salvador did could have been done by Ecuador. It could have been done by Bolivia, Paraguay, Uruguay, right? Everybody could do that. Like
yeah, that's what I see going wrong on the European side, and also like reason why, for example, I did fundraising for Union in the US. It's like even when they kind of say they're pro, like there's so much regulation that they're not really pro to actually like attract these kind of new categories of businesses. So you have this problem in the Netherlands, you have this problem especially in Germany, where like the kind of amount of paperwork you need to do to even start a startup, let alone a crypto startup, will take many months. And I've not seen many Dutch crypto companies manage to get a bank account. Actually, that's like one thing they filter for that might like get you instantly banned, and that is indeed something that really like hammers innovation. Then you wonder like why does a US stablecoin have more dominance than the EU, the Euro stablecoin? You realize, well, because the whole like ecosystem around it is obviously much more permissive and set up to actually support this innovation. And guys, we are nearing the end of this podcast episode. For our listeners, I'm curious, like, what should they do to stay up to date to your projects? What's the next thing they need to do to be informed on Talus?
Yeah, follow us on socials at Talus_labs. We have agents running on testnet right now, personality agents that you can interact with, and we're doing a giveaway for that. We're doing a lot of really cool stuff in the run up to our TGE, which is going to be coming soon. Yeah, I think if you're a developer, you should check out the Nexus SDK. Look into the kind of agents that you can build with our stack. These are really going to be different agents than what exists anywhere in Web3. And we're also creating a vision builder that we're going to have a demo out for soon. So something very similar to N8N, where a low code to no code experience visual builder, and you can create a workflow. So we're working really hard to empower developers and make sure that people can build cool stuff using our technology.
Excellent.
Awesome.
And for us guys, follow us at KiiChain.io. We have a public sale coming up soon, which is going to be really fun. Hope everybody can join in on that. I'd love to get everybody into the community, and it's going to be our public sale right before TGE. We should be at TGE towards Q4 or Q1 of next year. We're right in between that right now. We're wrapping that up. It depends how long it takes. It takes us in terms of the public sale. We right now, in terms of the whitelist, we're subscribed. So we'd love for everybody to join us on socials. And we have our incentivized testnet. We have season 2 operating right now. So we have a ton of incentives, giveaways, and a lot of auto. It's our testnet is called testnet KiiChain testnet auto, so you can get a ton of auto. And one of the interesting things with the way we're doing our rewards program is that we increase the staking, we increase the pool of key that we give away in auto, and the percentage conversion depending on the amount of users. So as the amount of users and registered users increases, so does the pool, and so does the conversion rate. So love for all of you guys to join, and thanks for sharing this time with us. We love to really share this message and get it out, because really super excited about what we're building.
I mean, thanks for much one, both of you. Interesting to see where Talus' progress, but also, to be honest, I was very much unaware of the kind of like economies in South America and how this is all playing out. So extremely excited for what you're building, and please can get some alpha and get on the whitelist for Key. Even though I haven't participated in the Incentivized Testnet, would love to participate in this.
Absolutely, gotta get you guys in. Gotta get you in too, Ben.
For sure, I'll look into it.
And I'll reach out to you after too, because I think I have a good contact that could be useful for you guys.
I'd love to work on something together. Let's chat for sure.
Absolutely.
Amazing. Then guys, thank you so much for coming on, and I'll check back in when the seal has progressed, and then indeed we should talk to on some integrations. All right, guys.
Absolutely. Take care, Ben.
Thank you all for coming in, and for our viewers, we'll see you again next week. Cheers, everyone.
Bye-bye, guys.